We've talked a lot about sort of the metadata and theory around post-seed. We thought it would be useful to get a good handful of entrepreneurs that have actually faced this problem, gone through this process, and have them talk to the audience about sort of what that was like and some of the context around both the raising of that fund, of that round, and what happened after. So I'm going to ask each of the panelists to introduce themselves and just give everyone your name, your company, and if you raised what you consider to be a post-seed round, what year did you do that?
Tony Vartanian, Jump Ramp. We're the publisher of Lucktastic. We did raise a post-seed round. It was with Bullpen, and it was about 2 years ago.
Stu Landesberg, CEO of Grove Collaborative. Grove is a brand and e-commerce platform for sustainable home and personal care products. Take a long view that CPG is going to move from offline to online, and we use our own e-commerce platform to both sell third-party goods, but really to do some awesome innovation in creating e-commerce first products in the CPG ecosystem. We did raise a post-seed round, closed in about July, and Bullpen led it.
I'm Justin Potter, CEO of Cleanify. Cleanify is a marketplace for local services, starting with cleaning. We did a post-seed round in spring this year.
Hey, Dan Greenberg here, founder and CEO of a company called Sharethrough, right up the street, about 200 people in San Francisco. We're the enterprise software that powers native ads for publishers like CNN, Vice, Hearst, Time, Gannett, like Facebook ads, but enterprise software for the rest of the web. And started the company in 2008. So raised a seed round in 2008, and hopefully I'll be able to tell the whole story of that. And ended up raising a post-seed in 2010 that it was a post-seed and then a Series A like 3 weeks after. I'll tell the story.
I'm Aarthi Ramamurthy, and I'm the founder and CEO of Lumoid. Lumoid is a try before you buy service for gadgets. We do drones, wearables, photography gear, all kinds of stuff, including Snapchat spectacles. So if you want to try them, come by. We did raise a post-seed round last year, about 13 months ago, from Bullpen.
Great. So in the interest of really sort of getting to the heart of the question, I think a lot of the discussion and questioning around post-seed, what is it, why do you do it, is that it bucks the standard assumption that companies should go from a seed to an A to a B to an IPO, which when I joined the venture industry 10 years ago was what every company was expected to do. I'd love to hear each panelist just talk about the calculus that went into the decision to raise the post-seed, what happened sort of before you did that. And again, it'd be great for, I think, the audience to just hear, was the decision to do post-seed because a large Series A was unavailable? Was it because a large Series A didn't make sense given that part of the business? Or was there some other rationale that you employed that made a smaller round at that time make sense for the company? And we can just go down the line for this one.
All right, so we're in a unique place. We're a consumer-facing product. We built this huge, if anyone knows Publishers Clearinghouse, we're disturbing this $1 billion plus business to create kind of reimagining a winning experience for consumer America. When we were in that position and talking to Bullpen, and we actually had offers from other funds as well, it just made sense to go, and I think it had a lot to do with, we believed in that post-seed concept. We had unit economics. We were doing really well, and in the things that really mattered, which was retention, monetization tools, and so it just made sense to take a round with Bullpen rather than some of the others. And actually, the others ended up participating in that round, interestingly enough, because they also saw the opportunity to go for a better A round moving forward.
For me, I think that the nomenclature from seed to post-seed to Series A, whatever it is a little bit sort of imposed by the venture industry on companies. I think most good CEO understands their own capital plan, and so if you say, okay, I need a certain amount of capital to get from one milestone to the next, at that point, at least for me, it was sort of like, I'm going to look around and see who the right partner is who understands, okay, given where our unit economics are, given what our next sort of big milestone is and the doors that the next milestone unlocks, who are the right providers of that amount of capital and have the right sort of strategic alignment with my goals as a founder and also with the company's goals at that stage. And so looked around, also talked to a number of folks, and it became clear that the product that Bullpen was offering really matched the company's capital needs better than anything else in the marketplace. And I'll give a quick plug for them that I think they also have a lot of expertise here in terms of understanding the right way to structure deals that create good alignment across the sort of team, other investors, and their own needs to position the company really well for future success. And so that was why we ended up going with Bullpen and with their product.
We did I did 2 or 3 meetings with some friendly Series A investors in January and February of this year, and quickly got the feeling that it was going to take a lot of time, and I wouldn't really get where I wanted to go with the Series A. On the flip side, I had all of our existing investors tell me that they would put in more money to a second round. So Bullpen coming in to do half that round was much faster for us to get back to work and just look at like a supersized Series A down the road.
So I think the best way I can answer this question is just to tell the story of the early days, and I'll do that quick. I started the company out of a Stanford program in like 2008, and we were strange in that we had revenue from day one before we even incorporated the company. Andre, our lawyer here from Silicon Legal, helped us incorporate it. And I'm not sure how we even did that. I think we had like $1 million run rate in revenue before we even had paperwork. So we ended up raising an angel round in 2008 with the storyline being we want to get socialized into the right circles properly. Ended up raising an angel round from Steve Blank, Ron Conway, Oren Hoffman, and a handful of others. Raised a Series Seed on top of that, which ended up being about $1 million in 2008. So a seed round of $1 million. And company executed and grew, but we also grew headcount and expenses. And so we got to a place in about 2010 where we had like a pretty crystal clear picture of the next chapter, but didn't have enough capital to invest in taking ourselves there. We were at maybe like a $5 million run rate and had maybe 20 employees or 15 employees, and it was working, but we needed to get more capital. Went out to go raise a Series A and fell like right on our face. We're an advertising company, and there's not a lot of love everywhere for advertising. We're enterprise software for advertising. And so this story is actually a story about founder-friendly post-seed rounds. Our investor Floodgate, who did the Series Seed, in the face of us saying we're having trouble raising Series A and like about to hit a wall, said, well, why don't we do this? Why don't we just give you like a convertible note, but really just $1 million, I guess you can call it a convertible note, $1 million convertible note, but at 0% discount. So we'll just give you a convertible note of $1 million at whatever the next round happens to be, so that you can bridge yourself and have confidence in meetings. And honestly, like 3 weeks later, being able to walk into the next chapter of VC meetings and say, okay, we don't need to raise money anymore. We want to raise money because of this plan, but we don't need to. The whole dynamic changed, and we ended up raising a Series A of about 5, 3 weeks later, and have raised, I think, like 30 since then.
We came out of YC summer 2013, raised a seed round right after that. Ours is part e-commerce. It's e-commerce, but with a rental model. So we started generating revenue from day one. Company grew, but what had happened was, we'd come last year to a point where the metrics were good, but not great. Like we weren't at a point where we could go raise a Series A. So we thought about it and said, well, we could try and go raise the Series A, and it's going to take us a few months to get there. Or we could pause, hit the metrics for post-seed. Let's raise a small round, not the Series A size check, get back to work, similar to Justin, and show the metrics that we need for like an actual Series A, build a few partnerships that we could, and sign that, and then get to this point. So that ended up to be a really effective strategy because it was fast for us to close, and I could get back to work. I'm a single founder, and it just helped a lot to just get to that point really quickly. So for us, it was very beneficial to do that.
So after the post-seed round, and this is going to be a question for anybody that wants it, but particularly for you, Tony, and for Dan, given that you've done subsequent rounds since the post-seed, talk a little bit about, as you assess what the Series A market wanted to see versus what the post-seed market needed to see, talk about what needed to happen between the raising of the post-seed round and the raising of a sort of big round. So Dan, in your case, not so much the 3 weeks later round, but the round after that. What do you think the gaps were that you sort of, to get into that supersize round operationally?
Yeah, so when I describe the story of our company to new employees, we do like a Sharethrough University every month for all the new class. And I find myself drawing the same picture for probably the past 4 or 5 years that looks like a bunch of concentric circles that look like orbitals wider. And it starts with this original seed of the business that was, the vision, I would say, was limited by the size of that orbital. The story we were telling was we can do video advertising better in social and native environments, and we can power video advertising in this super specific part of this niche of the web. And so the vision that we were talking about and like kind of what we were playing for was stuck within that circle. And I'd say with each chapter of the business and with each chapter of fundraising, the size of that circle got bigger. The seed and the core stayed the same. Like the mission statement I've had from the beginning, wordsmithed it, but like the core has been the same about helping enterprise publishers preserve and protect their futures. But like the way we do that and the size and breadth of the vision, moving from a Series A of 5 to a Series B, I think that was 12, and then we did another round after that. It was really about like finding a new way to confidently and authentically describe the next concentric circle of what we're playing for.
I mean, for us, I think we're in a unique space, right? You think of the consumer kind of products, and everybody we knew was we kind of, you got to be a good salesperson, know the objections, right? We already knew that they're going to stick us on traction and such, and so from day one, we wanted to show that we can scale the unit economics, that we would be amazing at acquisition, we would be efficient at onboarding, and would be great at re-engagement, reactivation, the entire kind of value down the chain. So it was about building value and then building an annuity around it. And so we'd gotten there, Bullpen came in, and what that allowed us to do is really, at that point, use the dollars that came in to further refine and grow. So we went from spending $150,000 a month to $1.5 million a month on mobile, buying only mobile traffic. And guess what? We were paying off our cohorts in 5 days. So that's our story. We're the #1 app on the Android store in the lifestyle category with Zillow and Tinder. We're starting to invest now on the iOS channel and building up. And what happens when we went to raise that next round, we already had the economics figured out, right? We already were great direct marketers. And I think everybody's got to be that to be successful. We hear today everyone talking about economics. It's going to be tougher to raise. Well, maybe we're not the 22-year-old kid that's fundraising, and myself and my co-founder Alex are a little older entrepreneurs that have done it before. And so we really focused in on really driving the business and saying retention, profitability, unit economics, that's what people want to invest in.
So one thing that we've observed a lot in this space is venture guys and people tend to be driven by a lot of social proof. And so a lot of the post-seed round tends to be collecting a bunch of people that are maybe interested but not willing to put their foot forward. Question for you, Stuart, and for you, Justin, just having watched those rounds come together in the last 12 months, talk a little bit about just the process of assembling the round and kind of what happened after the terms were agreed to and sort of you actually went to go do the post-seed round itself.
Sure. So the e-commerce space obviously is one that's been a bit controversial over the last few years. A lot of high-profile companies that have not lived up to some very high expectations. Also, CPG, and I'm sure you can relate to this, like cleaning, it's not the sexiest category, and one that our core customer is a 28-year-old mother of 2 living on $85,000 a year in the suburbs of Nashville. That's a very different life than many of the folks who are capital allocators in this room and in our networks. And so, we really did have a little bit of a product that was unsexy, but at the same time, I feel like our economics and proof of concept and traction, all that stuff are very, very good. And so we had a lot of support from our existing investor base, and I think probably a little bit more mature than most companies at the sort of stage we were in terms of raising capital. And so we had really strong support from our existing investors. And then, as soon as we had Bullpen come in and sort of catalyze the round, we had both existing guys come out and say, actually, I want to write, a check 4 or 5 times as big as all the money I've put into the company previously, and had the round oversubscribed in, probably within 10 days of having confirmation that, that Bullpen was in and having the terms set. And so, it was both a really strong signal and also, I think, a little bit of external validation for other folks who were already on the train and looking around saying, gosh, I just want to make sure there's not something I'm missing here.
How big did the round wind up being?
It ended up being 5.5, but I mean, it could have been larger if Paul would have let us.
Yeah, it was kind of in a similar space. One of our competitors was called Homejoy, and Homejoy kind of blew up right around the time that we were raising more money, and they had a lot of money, like $40 million, and that when I was looking at the Series A space and that happening, I knew that it was going to be an issue. It was a great thing for us internally, but externally, maybe not so great at that time. Our current investors, before the post-seed round, in our seed round, all said that they would give us more money. And I guess it was the only difference here was I came into Bullpen with half our round already done, and Bullpen just closed out the other half really, really quickly. Because again, our unit economics and everything made a shit ton of sense.
So as you think about now being on the far side of this round, in some cases by a year or even a few years, what advice do you have for entrepreneurs that are out there that have raised seed money, that have gotten somewhere, as they're sort of trying to assess, does this kind of a round make sense for them? Should they pursue it? Should they go pursue a big Series A first and then pursue this? How would you counsel entrepreneurs that are thinking through these questions? And Aarthi, why don't we start with you?
Yeah, I think it depends on every business out there. I think each the company is unique by its needs, and I think what's happened is in the last 12 months, suddenly there is chatter about unit economics and fundamentals and margin structure. I mean, this is something that should have been a given from the first day. I mean, when we first started, not to brag, but we were very, very scrappy. We continue to be very scrappy, and that's helped us a lot. We would have died like 5 times by now by just following the valleyness of the whole situation. And I think fundamentals is important. Setting milestones is important, and you will have, when you get to a point where you have specific metrics, you're not able to hit metrics, you have a specific partnership or a goal you want to hit, that's the point where you have to come to realize, is it going to be possible for you to hit that next milestone in fundraising? If not, have a backup plan. Like, have a plan for make a decision and move fast than in 6 months we'll get there kind of thing. If you don't have a plan, it'll really hurt you. So I think just focusing on the fundamentals is key. And then it'll guide you to what you want to do next.
I would jump in and give a totally different angle of advice, but I also totally agree with all of that. Different advice, I would say, whether you're going to raise a seed round, post-seed, A, B, there's some universal advice that's been helpful for me, which is that, as we all know, VCs invest in you just as much as the business or the idea, and that's even more true at the early stages. That's not new advice. But the way that I apply that is to say that because of that, a VC should never be bringing more energy into the room and never be bringing more enthusiasm into the room than you are. If you're a founder of fundraising, you need to be the source of enthusiasm, you need to be the source of truth, the source of excitement, and bring people along with you. And so with that as the concept, what we've always done is said, what's the one metric that I and our executive teams can get authentically, truly excited about? Like, what is that one metric that we can commit to and track and optimize for, that as it grows, if it grows, we really can jump on the table and shout from the rooftops about our excitement about that metric. And so for us, that's shifted over the years. Today, that metric is the amount of money that publishers like CNN and Vice are making by selling their own native ads. We make a tiny margin on it, so it's more like enterprise value than actual net revenue for us. But we're now up to, I think it's an $8 million per month run rate of publishers selling their own native ads on top of our platform, on top of all the rest of everything we do. And so if I was to go out and raise more money today, which I hope I don't have to, but if we do, and it'll probably be in a couple of years as like a pre-IPO concept, but not yet today, that would be the metric that I would continue to track and optimize against, because if that doubles and triples, I can shout from the rooftops about that metric.
Anyone else?
I'll jump in. I mean, I think definitely, unit economics, all that matters. Your metrics matter. You got to know your business better than everybody else. So you got to be intimate with your data. You got to be intimate about your customers' data. If you, I grew up in sports. You kick ass, take names, and good things happen. I think that's part of it as well. And then the other one is, we had SoftBank Founder Collective. Actually, Chris from Thrive was here earlier. We had a good round early on. And so if your current investors don't want to put more money in, that's a very different story than when you go and you say, everyone from Zelnick, Strauss Zelnick and Zelnick Media, from our super angels want to double down or want to take half the round, right? That sends a strong signal, because just like in business, the repeat you keep your customers, it's hard to get a new customer, right? So if you get your current rounds investors committed earlier on, and it's about nurturing those relationships with them. So a lot of people talk about you raise a round and you're fundraising and you're meeting new people, but you got to really nurture the relationship with everyone that's in your round, from advisors to angels and super angels to some of the more institutional guys like we had, like SoftBank and Founder Collective. So people that weren't even on our board, we were nurturing those relationships, knowing that we're going to get to this next round.
Yeah, I would really echo what Tony just said about your existing investors are absolutely your best asset if you're thinking about a post-seed type structure. Those folks are invaluable. The only thing that I would add is to sort of know what kind of founder you are. Like, I am not technical. I'm not going to go in there and blow anybody away with grand visions around product or anything like that. But I have a really strong command of metrics-driven businesses and ROI and cash conversion cycles and things like that. And so finding the partner that had sort of similar orientation and similar grounding in those things, led to a much higher percent chance of success. And so if you can match that partner up with the amount of capital that you're looking for your own capital plan, I think that's probably the best advice I could give.
We only have a couple more minutes. I think we've heard in almost every session so far questions about macro uncertainty going forward. How as entrepreneurs, how are you thinking about operating decisions that lead to either an additional fundraise in 2017 versus achievement of operating cash flow and alleviating the need for fundraising? How are you processing that decision for anybody who has a thought?
For us, from day one, we always said we don't want to take more money.
Yeah.
So we've always operated on this kind of the only, we're working toward profitability, and the only thing that stops us from profitability is that we're hiring, we're getting smarter, we're doing the things that we need to do to grow the business. So for us, we're not looking at raising money. We think that, being profitable and being able to still be aggressive in growing the organization is our vision. We don't want to be stuck in and I think, people said, the raise when you don't need money. But the reality is that, SoftBank is one of our originals. They're always, if you ask them, they'll say, you guys are so frugal compared to everyone else in our portfolio. That's because we actually treat it like it's our dollars, and we are, like I said, on this path to profitability. And, that's just stay laser focused on that. Stay disciplined on your thesis. Don't let VCs disrupt you because there's a new shiny object or a new piece. I think if you stay strong to your thesis, then things will work out and you'll work through it.
Yeah, I'll just add that I think any operating plan that doesn't give you optionality is probably a dangerous one. But if you have a good relationship with your partners and your investors, it's very much of a collaborative thing. And I think the folks we've worked with have always been good to us. And so I trust our board members and our investors that if we make a plan together and we execute on that plan, that they're going to provide the support to, whether we want to go the profitability route or raise more money, that we're all going to be aligned on that.
talking about macro. Oh, sorry. We're going down the line. I'll be quick. Talking about macro uncertainty, we have an office of about 10 in Canada, in Toronto. And I'll say since election day, we've had probably 6 people come to me and say, hey, can we move to Toronto? An engineer actually did move up there, and there's a couple others who are knocking on the door.
Yeah, I echo this sentiment of hovering around profitability. So we've never really been profitable, but we've always maintained this optionality that if we didn't raise a post-seed, I'd still be here and I'd still be growing, maybe just not as fast. That is what the money is for in the end. It's just the speed of us being able to do stuff, but always having that optionality, because fundraising sucks.
And profitability for sure, echoing all the sentiments here. I think one other thing is finding parts of your business which you can get help from other companies which are like complementary to you. In our case, inventory is the thing that costs us a lot. So finding means to go get inventory for free or for super cheap really, really helps us. And so just being smart about what will help you to get to that point where you're profitable or you're at this position where it's a really strong collaboration and you don't have to go raise right away. That really makes a lot of sense.
Great. Well, thank you very much to the panelists. If you have more questions about actually being a post-seed entrepreneur, find any one of these fine folks and ask them away. Thanks.
Thank you.